Welcome to Better Returns, where you will learn how to escape the volatility of the stock market by passively investing in real estate like a pro. 90% of millionaires earned and maintain their wealth by investing in real estate. We will share real-life examples from savvy investors so you can do the same. This show is for educational purposes only and should not be considered legal, tax, or investment advice. As a kid, he was into model railroading, big time. Your host and my dad, Matt Hansen.
Welcome back to Better Returns, how to invest like a pro. I've got one of my friends, Marshall Sykes, on the call here with us today to share some nuggets of information from his years of experience. Marshall's the president and owner of Capitano Investing Group. He's a real estate investor at heart, and he grew up in a real estate investing and new single-family home development family. He's the general partner in over 3,500 units of multifamily units and has owned several single-family home rental properties over the last 25 years. So he's got some depth of experience to share with us today. Welcome to the show, Marshall.
Matt, thanks for having me. It's a pleasure to be on here today with you.
Thank you. Well, I always like to start with the origin story, kind of a little bit about how you got started in real estate and about your personal background. It's always interesting to hear what your background is professionally and otherwise, and how that relates to how successful you are in real estate.
Yeah, so I actually grew up in as we talked about, a real estate development family. My dad retired from the Army, and he wanted to work for himself, like many people do in America, kind of create your own destiny. And so he learned the building trade after he was out of the Army. He was around 40 years old at that point, retired from them, getting a paycheck, so he had a little bit of time to do that, but so he learned the building trade. Him and my mom would build two houses at a time pretty much. And so they're both builders, and they would keep one as a rental and sell one and to create more money for the next two, I guess. So when I was a teenager, I started helping them on the job site, learn the trades. And, it was a little bit boring for me as a teenager because I couldn't use my mind, but of course I got the work done and all that. But, and at night I was one of 8 kids. So at night in the living room, my mom and dad would talk about the business side of doing the development. So I learned that even though I wasn't even thinking about it, I kind of learned, hear the conversations and you learn about it. And, so I kind of put all this in the back of my mind, went to engineering school at NC State, I got my engineering degree, and then I went in the Navy as a civil engineer corps officer, where I did construction and development for facilities on the bases. Never thought I'd do that either, but that was God's plan for me in my life, I guess. And I thought I'd just go in the Navy for 4 years and I'll get out and have some experience. But now I really loved it. I loved the Navy. It was very challenging. You learned a lot. You grew a lot as a person. So it was just a lot of fun for me. So I ended up staying in for 25 years and retiring as a captain. But about 10 years into my career, my wife and I were like, let's start getting real estate, building up our real estate portfolio. Because, when you're later on in your life, you want to retire on your terms. And if you have some rental income, or other passive income besides maybe what your corporate job is going to give you or military job, you can create your own sources of income. And that's what we looked at with single family homes. So we had around 10 rental units for just single family homes. And so we built that up, paid some of those off, and fast forward another 15, 20 years, I decided we just started hearing about these multifamily syndications. And I'm like, oh my, I've always wanted to do multifamily because I did barracks in the military. We developed 10,000 units in the military, right? It was a big program in Camp Pendleton in Southern California where I was in charge of. But they're very similar to multifamily. Same thing, except the units are different, right? They're smaller. But the amenities and all that are the same. So I always thought I want to do that, but I didn't know about syndications, right? So syndications are not really widespread. Wall Street doesn't want to know. They don't really talk about that at all, right? And so I learned about those and I started investing as a limited partner, as a passive investor,
Mhm.
and learned a little bit more of the lingo of, the syndication model and all that. And then I decided to become a general partner
Gotcha.
where as you said, I've been in over 10 deals and over around 3,500 units.
So it really is in your blood. I know as a kid, I grew up in a drugstore and a retail business, and the stuff you hear at dinner every night, that it becomes part of your DNA. And like yours was real estate, particularly development. Your parents are building single family homes and rental properties and stuff. So yeah, you didn't realize you're being educated, on the sly by your parents, and that planted the seed that, okay, I should be owning real estate to grow my wealth, which is fabulous. That's wonderful. That's wonderful.
Yeah, my dad always talked to us about it, but I didn't think I'd really go into it that quick.
Yeah.
But every one of my brothers and sisters has either rental property or one of them does like a multifamily developments even. So it's very interesting.
Yeah,
You do learn a lot.
Yeah, it's in your subconscious that, okay, this is something I should be doing. My parents were really successful at this, and this is why I should be doing it. That's great. So how did the military help you? Again, thank you for your 25 years of service and being at a um, uh, captain level. That's pretty impressive. So is there things that you took from that you kind of applied to multifamily?
Yeah, definitely. So what I did in the military, we had to learn contracting, federal contracting. So we had to become experts at federal contracting, as well as experts at construction management.
Oh, right.
And the other one was the facilities management. So asset management of a facility. So the engineering side of it, running the public works, running the utilities, or just dealing with planning of the new facilities or existing facilities. So all that piece, all of those things are very applicable to multifamily syndications. So being a general partner, you're going to deal with contracts as with doing like maintenance contracts or small renovation projects, or like the trash collection, all those type of things. So that helps in asset management as well. And then asset management itself, dealing with people, you learn that in the Navy as well, because you're doing leadership. Well, the whole time I'm doing leadership. And most of my career in the Navy I was working with contractors and civilian employees that weren't federal employees, basically, that were not military. So sometimes I was in a unit with military unit, but that was rare for me, actually. Most of the time I was working with federal employees.
You're working with civilians then. Yeah.
Civilian Navy.
Bit of a role that was more external, not just within the military only staff. Yeah, that's kind of unique that you did. Your job was really mostly exposure to people outside of the military.
Exactly. Yeah.
Yeah, that's super relatable. Yeah, everything you talked about, asset management, the herding all the cats to make a deal work. It's the exact same thing that you have 25 years of experience doing.
Yeah.
Very relatable. Let's talk a little bit about within multifamily, the different asset classes within multifamily, how people can kind of diversify.
Yeah, so most of my focus on commercial real estate has been multifamily. Have I thought about other things? Yeah, possibly, self-storage or industrial or something like that. But right now, focused on multifamily. And I decided early on that what I wanted to do was test as a passive investor. I wanted to kind of test different markets and different operators to understand them, because at that point I didn't really have a go-to operator. And so I also wanted to test the different asset classes. So a class C or class D are going to require a lot of turnaround. They're going to be harder they're going to have less occupancy. Yeah. They're going to be harder to do renovate. They're going to require more renovations, and just turnaround takes a lot longer.
Yeah.
And class B is kind of the middle ground. It's a pretty relatively new property, but you want to do some light renovations to bring it up to standards, right? Bring it up to today's type finishes and all that. And class A is usually a brand new facility that is pretty nice, really.
Right.
You can definitely see yourself living there, right? So what I wanted to do was, and I think it's smart to do, is if you're investing in a lot of different multifamily properties, it's probably good to do some in Class C where you might have better returns, but they might be more risk involved. But your return might be better in the long run
Right.
if the operator does correctly. And the Class B is kind of the middle ground again. And the Class A is more, it's definitely stabilized. The occupancy is good. You got a really high paying tenant base probably. But your cash flow is, you're getting more cash flow there and less about appreciation. Certainly not value add as much. A value add renovation is what we call it for Class C or Class B properties. So what I do with my investors is I try to, the same thing I do is I want to have 2 or 3 in each one of those categories, right? I want to invest in different properties on each one of those categories, so I have a good mix.
That's a really good strategy. I mean, even within an asset class, you can diversify because right, the Class A's, and we have friends that do Class A's. The upside isn't huge when you sell it. You're gonna cash flow on day one. You're gonna get those quarterly distribution checks pretty much in the first quarter, but you don't get the big value add that we do in our Class, B, C pluses. That when we sell it, we usually double our investors' money. So I think that's a really good point as an investor. First off, get out of Wall Street, at least some of your assets, some of your money out of Wall Street. And then even within real estate, I do the same thing. I'm in all sorts of different asset classes, entitlements, raw land, some new development stuff that I passively invest as well in, just because I want to diversify my portfolio. But in the essence, I really believe in real estate, just like you do, Marshall. It's like, you have a track, your family's proven this is a really way to be successful and grow generational wealth.
Yeah, there's so many ways to benefit from real estate. You got your quarterly cash flow or monthly cash flow, but you also got your appreciation. You have your tax benefits. I mean, you can go on and on.
Yep. So what markets are you liking right now? Because we talked about the different A, B's, and C's. Like, what markets are you most interested in?
Well, I just recently moved back to North Carolina where I grew up. And I like the Raleigh and the Charlotte and Greensboro market. So I am definitely looking in those areas right now. But I don't have, my very first investment was in Raleigh. It basically doubled my investment in 2 years.
Wow.
So it was a Class B property. It was in the right timing of the market, obviously, but it's hard to do that quick most of the time, but I was very fortunate with that. So I have had investments in North Carolina before, but now I don't have any. So I'm looking for that. I like Florida. I've liked Florida in the past. Now it's and maybe it's becoming more difficult. We got to figure out the insurance, because the insurance has kind of gone crazy there with the Hurricane Ian coming through last year, causing a lot of ripple effects. And then I still like Texas and Arizona markets. I mean, or Phoenix particularly. Those are always good markets.
Do you have any challenging, maybe some of that you passively invested in, any challenges that you've encountered that maybe you could help other people avoid in the future?
Yeah, I mean, I think, if you invest a lot in real estate or in other things that investments, you got to really understand what you're investing in. And sometimes there's some things that maybe are rare, but the markets might change and something will happen. Right. So, with the rise in interest rates, that has caused a lot of impacts with multifamily investments. And so there's got to be, when you're investing with an operator or with an operator, you got to make sure the operator has a plan for those contingencies, right? You got to make sure they can handle, they have some kind of a little bit of contingency fund or some deep pockets where they can overcome some of the rare occasions that might happen.
Yeah, that you need to look at all the partners too, particularly the asset manager. That's the person that's going to be running the show. But you're right, all the players really strong, because that's critical if things go sideways, because there's things you can't control, like you said, the extreme weather in Florida or whatever, some economic event that nobody knew was going to happen. It really, you need to have that that strong track record of somebody that really knows what they're doing. That's really cool.
Right. Yeah. So I'm invested in 5 different properties in Florida. None of them were really hit by the hurricane,
Good.
but all of them, because they're in Florida, they're going to increase in insurance. And not only in Florida, that's causing ripple effects to other places too. Even one of the properties I'm in Texas, they're trying to increase the insurance by a lot, by way too much in my mind.
Yeah, we're seeing that. That's gonna, interest rates and then insurance. Those are your 2 biggest expenses in running a large multifamily apartment complex. So yeah, both of those are not doing great at the moment. You're right. So
Yeah.
that being said, so what's your kind of, Marshall's outlook, for the rest of the year type thing, based on the content you've consumed and your expertise, just your personal opinion. What do you think's going on with the market in the next?
Well, I think we're really at a decision point on what the Fed wants to do with their interest rates, right? They've seen how it's impacted we had a couple bank failures over the last week.
Yeah.
So that's kind of causing some concerns. And so there's got to be some kind of decision on that. I don't think they're going to keep ratcheting up the interest rates because of the bank failures. I think there's going to be some hesitancy on doing that. But I do think it's not going to go down anytime soon. So it's going to be hard. Your interest rates still going to be a concern for the next year or so. But I also think that if a deal, there's a lot of deals on the market right now. And if a deal really pencils out really well, I want to be part of it because I always want to continue to invest in real estate because you can make good money off of it. And even in a down market or a good market, you've got to pencil out the right way, right? You have to look at your numbers.
Right. So what would you say to the individuals? I've talked to a lot of investors, as you do as well, that they're all in cash preservation mode. They're afraid to invest in anything because they just want to hold on to it. Now, we know that's not a really good idea. Okay, the off bank that fails and things like that aside, the fact is that your money is sitting and you're losing. If it's sitting in the bank anywhere, even if the bank is safe, you're losing anywhere from 5 to 10%, with inflation and everything else. What would the reason being you'd give people to say, hey, you know what, you should put some of that stuff in real estate? What do you say?
I think that, like I said, some people are going to have to sell their property. So there's going to be opportunities over the next 6 to 9 months of buying into a good asset that is at a good price. Mm-hmm. So I think, but if you're going to do that, you got to think about, if it's going to be a variable interest rate, are you going to have a rate cap? And make sure that the operator is going to have a rate cap. Otherwise, you want to go into a fixed rate term. And if the numbers work for those two, then that's going to be a good deal for you. It should be a good deal for you. The one thing I think, because you want to have certainty as an investor, right?
Yes.
You want to trust that things are going to happen, that they've taken care of, they've thought about the interest rate issue, and you want to have certainty as an investor so that you're not a month into it, the interest rates go up and you're still right. Your prices, your mortgage goes back up, so yes. That's not going to be good for you. But definitely, I would talk to operators, make sure you ask those hard questions,
Yes. You mentioned the word rate cap, and I don't think I've talked about it on the show. So go ahead and explain that really what that is, so people know.
Basically, rate cap is insurance that you can keep your interest rate at a certain level, so that if the Fed does raise interest rates a lot, which they did last year, then you're protected as an investor or as an owner. You have better protection.
Yep.
So basically, it's insurance for your interest rate.
Yep. And in years ago, you would pay whatever $40,000 or $50,000 for a rate cap to say, okay, I've got a loan at 3.5%. It can't go over 4.5 or whatever. And it was pretty reasonable. Let's say $40,000. That same $40,000 rate cap now is like hundreds of thousands of dollars because of the uncertainty in the economy and things like that. So those are the things that are impacting deals and how we can pencil. And it's harder to make a deal work. But as long as you're doing the right thing and you factor all those expenses in, it's fine. If it still works, you put in your extra 100,000 or so for the rate cap, you're great. Those are questions you should ask as a passive investor too. That's really
exactly, because the extra 100,000 is not going to be a lot when you look over a 5-year, 6-year period of holding. It's not going to be that much, but it's worth having the peace of mind of having that insurance on that.
Yep. And when you're buying a $30-40 million property, it's not a significant number. It seems like it to you and I as a personal out of your bank account. But when you have a big business, and an apartment complex is a business, its own business entity, it's really not that big of an expense. But the protection is so great, to have that, your rate can't go higher than a certain point. So good. I'm glad you brought that up. That's something we never talked about.
Okay.
Well, are you ready for the lightning round, Marshall?
Oh, sure.
Okay, these are tough ones.
Is there some lightning out here? It's sunny here, though.
It's fast. There's no cloud. There's no participation expecting. Okay, number one, first question. And this is going to be interesting because you're from a big family. What was your nickname as a child?
Oh, my goodness. Yeah, I was 7 of 8. So I was the youngest boy. We had 4 boys, 4 girls. I was the youngest boy. Since my name's Marshall, it's kind of unique anyway. So I didn't have a lot of nicknames in school or anything, but I guess within my family, my nephews would call me Marshmallow for one thing. I think another one was Gunsmoke was very popular when I was growing up, and there was a Marshall Dillon on
I knew you were going to say Marshall Dillon, yes.
So I've had both of those nicknames.
Oh, that's good. That's fun. With a family that large, you're going to have one because it just happens.
Oh yeah, we definitely had nicknames for each other.
Okay, number 2, a morning person or night owl?
Oh, I'm definitely a morning person. I used to even when I was 5 years old, I used to get up at 5, ready to go hit the swimming pool, trying to get my mom to take me to the backyard to go swimming. So yeah, I've carried that on until I still get up, 6 or 7 in the morning right now. Even though
being in the military, didn't you have to anyway? So it was great that you already had that predisposition.
Yeah, in the military, definitely we would start early. Sometimes we'd have, PT at 7 o'clock, or 6 o'clock, even sometimes different units. But yeah, we definitely it's definitely a morning type of business in the military.
You're blessed to have that in your DNA. That's great. Number 3, what would be the first thing you do if you won the lottery?
Oh my goodness. I tell you, well, first of all, I like my financial planning myself. So I do a lot of financial planning myself, but I would say I always think it's important to tithe. And so I would give 10% or some amount, I had to think about that pretty hard, to God and let, for his work. So that's the first thing I'd do, I think.
Excellent. That's great. Number 4, if you could live anywhere in the world, where would it be?
I was stationed in Italy when I was in the military, in Sicily. I don't know if I'd maybe not live in Sicily, but I would live somewhere in Italy on a beach and be able to access the train and travel as much as I could in Italy and, eat the really good food in Italy. I loved it. And gelato.
Oh my gosh, gelato's my favorite. Yes. And I want to come visit and stay in your guest house on every summer if I can.
Oh, absolutely.
I love that. That's really good. Italy is awesome. I agree. And number 5, what's the one piece of advice you would give to new investors to help them get better returns? One key nugget to a new investor.
I think, I think I like the diversification of different asset classes, first of all, but I think we said that one already, so I can't use that one. But I would definitely get to know the operator. Make sure you have faith in the operator so that they can work. They're going to work hard. They're going to stay with it, because sometimes deals can get very difficult. So you want to be able to have trust in the operator that they're going to stay with it and make it work and make the return on investment.
I would agree. That's the key thing. And they say that, a good operator can make a bad deal good, but a bad operator can make a good deal bad. And that's just what you said, is like, you really got to, that person, if they're good, they're going to be able to weather the storms and pull it out if something sideways goes on you out there. Good. Great advice. Great advice. So Marshall, how can people get a hold of you to learn more about what you do?
Yeah, they can certainly reach out to me on my website, Capitano Investing Group, where they can download a free resource there that helps them. It's my top 5 investment criteria for investing in multifamily. They can get that free resource there and link in with me there. But they also can connect with me on LinkedIn as well.
Outstanding. And that information will be in the show notes as well. Thanks so much for being on the show today, Marshall. It was wonderful to hear your story. You're doing great things and will continue to, I know.
Matt, it was a pleasure being here. You make me be able to talk with ease. Appreciate all your comments.
You bet. Take care.
Thank you. Bye-bye.
And that's a wrap. Thank you for listening to Better Returns, brought to you by Hanson Holdings. If you enjoyed this episode, please leave a 5-star review because it helps others discover this valuable content. If you would like to earn truly hands-off passive income, go to hansonholdings.com, where we help you invest in large apartment complexes to grow your family's wealth. See you next week with another awesome episode. Have a great day.